Hello and welcome to this module on the Truth in Lending Act, or TILA. TILA is also known as Regulation Z. It was passed in 1968 as part and parcel of the Consumer Credit Protection Act, and it's operated by the Consumer Financial Protection Bureau, or the CFPB. Now, the purpose of TILA is to ensure that consumers make informed decisions about financial credit, and here you want to highlight the word financial credit. TILA is all about ensuring that consumers make informed decisions about financial credit. Let's talk about TILA's applicability. TILA applies to residential mortgages of 1 to 4 unit properties. It does not apply to commercial or non-residential loans. Let's talk about TILA's disclosures. There are several TILA disclosures that you need to be familiar about. The TILA Disclosure, the Initial Truth in Lending Statement, or the Initial TIL, the Final Truth in Lending Statement, or a Final TIL, what you should know about your HELOC, the Loan Estimate, the Closing Disclosure, the HOEPA Disclosure, which is also known as the Covered Loan Notice, the Notice of Right to Cancel, the Consumer Handbook on Adjustable Rate Mortgages, the CFPB's Home Loan Toolkit, the Early ARM Disclosure, and the TILA Servicing ARM Adjustment Disclosures. Let's talk about the Truth in Lending Disclosure, or the TILA Disclosure. Now, the TILA Disclosure requires that borrowers receive disclosures about important terms of credit before they're legally bound to repay the loan. Consumers must receive TILA disclosure within 3 business days of signing a loan application, or at least 7 days before closing. The disclosure includes the annual percentage rate, and the APR is the cost of credit expressed as a yearly rate. It includes the finance charges, which is the cost of credit expressed as a dollar amount. It includes the amount financed, which is the dollar amount of credit provided to the borrower, the total payments, which is the total amount paid over the life of the loan for principal plus all finance charges. Now, you're probably wondering, what is the annual percentage rate? So let's do an annual percentage rate overview. The annual percentage rate represents the effective interest rate, or the total financing rate. And the APR basically equals the following. It's the interest rate plus other mortgage financing costs. The APR includes all of the following. It includes the base interest rate, the origination fees, underwriting fees, closing costs, and document preparation fees. Now, the APR is a higher percentage than the interest rate since it includes other loan financing costs. Remember, the APR is equal to the interest rate plus other mortgage financing costs. With this in mind, you need to know about annual percentage rate tolerances. The APR must be redisclosed before settlement if it's quoted incorrectly by more than 1/8% for a fixed rate loan. Now, for an adjustable rate loan, that percent is different. APR must be redisclosed before settlement if it's quoted incorrectly by more than 1/4% for an adjustable rate loan. And this makes sense. An adjustable rate loan will adjust by itself. So the tolerance there is a bit greater. It's 1/4%. For a fixed rate loan, the interest rate is supposed to not change. So the APR tolerances is a bit lower for a fixed rate loan. For a fixed rate loan, it's 1/8%. Let's talk about the Initial Truth in Lending Statement, or the Initial TIL. Now, the Initial TIL gives an estimate, and here you want to highlight the word estimate, of the costs for financing. Now, it's important to understand that the Initial TIL is provided for reverse mortgages and HELOCs only, and is due at application or within 3 business days if the disclosure is mailed. So what about the Final TIL? The Final Truth in Lending Statement is provided so that the cost for financing can be compared with the Initial TIL, and it's due at closing or 1 day prior if requested. Importantly, you don't see this on the slide, but you should understand that the Final Truth in Lending Statement is provided for reverse mortgages and HELOCs only. What you should know about your HELOC is an important disclosure to know about. You should know that it's also known as When Your Home is on the Line, and it provides information about HELOCs, and is due at application or within 3 business days of the application. Now, the loan estimate details the estimated costs of the loan on closed-end loans. It's a 3-page document. It replaced the good faith estimate and the Initial TIL. And the loan estimate is due at application or within 3 business days. It's required by TILA and the TILA RESPA Integrated Disclosure Rule. The closing disclosure, on the other hand, details the final cost of the transaction on closed-end loans. It's a 5-page document, so it's 2 pages greater than the loan estimate, and it replaced the HUD-1 settlement statement and the final TIL. It's due 3 business days prior to closing of the loan. It's required by TILA and the TILA RESPA Integrated Disclosure Rule. The HOEPA disclosure is also known as the Covered Loan Notice. Now, HOEPA stands for the Home Ownership and Equity Protection Act of 1994, and is required for borrowers with high-cost loans, which are also known as Section 32 loans. Now, high-cost loan thresholds are important to understand. You have to understand the thresholds to know what a high-cost loan is. So what is a high-cost loan? It could be a first lien transaction greater than 6.5% than the prime offer rate. It could be a junior lien transaction greater than 8.5% than the prime offer rate. And it's any loan with total fees and points paid by the consumer at or before closing exceeding 5% of the total loan amount. And the HOEPA disclosure is due 3 business days prior to closing of the loan. Now, the notice of right to cancel is important to understand. It's required for refinance transactions on primary residences, and it must be provided to all parties with ownership interest. Now, the creditor must provide 2 copies of the disclosure to each consumer with ownership interest in the property. And the right of rescission is extended to 3 years if a copy is not provided to each consumer with ownership interest. The notice of right to cancel is due at closing. So far we discussed the following TILA disclosures. Now we want to discuss the next disclosures, which begin with the CFPB's Home Loan Toolkit. So let's discuss the CFPB's Home Loan Toolkit. The CFPB's Home Loan Toolkit is also known as the Special Information Booklet. It informs the borrower on the mortgage process, the closing costs, and how to be a successful homeowner. And the CFPB's Home Loan Toolkit is due at application within 3 business days if mailed. The Consumer Handbook on Adjustable Rate Mortgages is an important disclosure to know about. It's also known as the CHARM booklet, and is provided to borrowers with ARM loans. Now, TILA requires the CHARM booklet for all applicants of adjustable rate mortgages. It must be provided within 3 business days of receiving a signed loan application. And the CHARM booklet provides the following. It provides an overview of adjustable rate mortgages or ARMs. It provides explanations of how ARMs work, and it discusses risks associated with ARMs and how to reduce them. Now let's discuss the Early ARM Disclosure. The Early ARM Disclosure, on the other hand, provides specific information on the consumer's adjustable rate mortgages. And here you want to highlight the word specific information. This is specific information on the consumer adjustable rate mortgage, and it's due at application. Additional TILA disclosures include the following. It includes the TILA Servicing Adjustment Disclosures, which are these 2 disclosures. The Initial Interest Rate Adjustment Disclosure and the Ongoing Interest Rate Adjustment Disclosure. So let's begin with the Initial Interest Rate Adjustment Disclosure. The Initial Interest Rate Adjustment Disclosure is an important disclosure to know about. It provides information regarding the servicer, it provides the effective date of the new interest rate, and it provides the new payment amount. Remember, this is for ARM borrowers. The Initial Interest Rate Adjustment Disclosure is due 210 to 240 days before the first rate adjustment. The Ongoing Interest Rate Adjustment Disclosure is a similar disclosure. It provides information regarding the servicer, it provides the effective date of the new interest rate, and it provides the new payment amount, but it's due 60 to 120 days before the rate adjustment. And this concludes our module on TILA disclosures.